Hello and welcome to the Movie Market Podcast. I'm J.R. Gondeck and I'm joined as always by David Sokolovsky. David, let's jump into notable market activity in February. Kind of a lot of momentum and things moving within the market. So let's start off recapping February.
Yeah, Jared. So February, like you said, a lot of momentum and really a strong month, particularly for tech and really, within tech, really in the conductor space specifically. If you look at what the S&P 500 did over the last month, it was up about 5%. But again, tech was leading the way, up about 7%. And if you look at other areas of the market, real estate and utilities were down for the month, and are down year to date. And then kind of highlighting the weakness in some of the high dividend paying stocks and value companies. And so if you look further, high dividend paying stocks were down for the month. They were down in 2023 and are continuing kind of that negative trajectory in 24. And then if you look on the bond side of things, on the fixed income market, you again are negative for the year, with interest rates rising slightly, particularly on the longer end of things. Within our portfolio, the bonds remain positive, just because of the short duration and the nature of the portfolio. But again, a kind of an uneven market, and again, seeing continued weakness on the value side, and really seeing a lot of kind of growth and momentum behind some of the tech names. And so I guess the question, Jar, is will that trend continue, and what do we see looking ahead?
Well, if you look at one of the biggest reasons that you saw interest rates jump in February is the Fed, right? And the Fed continues to waver back and forth between, do they want to increase rates? Do they want to cut rates? And again, you got a little inconsistent data in the month of February. Inflation was a little bit higher than expected, which produced the thought in the market that the Fed is going to push off their interest rate hikes, a little bit longer, which, naturally led to interest rates rising, which kind of brought down the rate of return on fixed income portfolios. But if you look specifically at the Fed, this month with the March meeting in a couple of weeks, March is kind of setting up to be a little bit of a volatile month, especially around the Fed. And again, a couple of things I think to note. Number one, if you look at the Federal Reserve balance sheet and just kind of recap the last 5 years, just interesting to see, the huge expansion during COVID and, what happened, after 2020, 21, 22, where you saw the balance sheet ballooned to almost 9 trillion, right? And that produced a lot of the inflation we're dealing with the benefit of hindsight. The Fed really wanted to make sure we were through COVID and there was plenty of liquidity. Well, that led to a couple of years ago with the bidding wars in real estate and a lot of that excess. And since 2022, the Fed has pulled, close to 1.5 trillion out of the balance sheet. And again, by this summer, they're likely on a path to kind of reduce the balance sheet back to kind of the initial surge post-COVID, right? And then you throw that in with the blip last March around the banking crises that we felt. Some of the emergency facilities expire this month, and you kind of have the Fed meeting talking about pushing out the rate cuts. So put all together, and there's good reason that intermediate long-term rates moved up. On the other hand, it could be a head fake type of situation like it was last September with the Fed thinking that the 5% GDP that we experienced in third quarter was going to continue, and it just didn't. So a couple of things we're watching for this week. You get a lot of employment data, on the labor market. We want to see retail sales, which are super negative in January. Is the consumer kind of tapped out and the economy is really slowing down? And then obviously you want to see more on the inflation side to see if January was a blip on inflation, or is inflation going to remain sticky ahead? And again, these are definitely notable things to watch around the Fed.
Jared, I think your point around the Fed balance sheet. So one of the things, if you look at that graph, you had the Federal Reserve continue to expand their balance sheet really right up to the rate cut. And so there was a lot of monetary easing going on at the same time, both through the balance sheet and then through lower interest rates. And as interest rates have gone up, the balance sheet has come down. And as you mentioned, the Fed has continued to pull assets out of the balance sheet. So that is one of the ways that inflation, it kind of reduces inflation and tempers inflation, and obviously having some of the assets coming out of the market should help improve that. But again, as we look ahead, it is going to be more challenging to get below that 3% inflation headline number that we've been talking about in previous months.
Well, and if you think back a year ago, David, last March, we were kind of going through some of those banking headlines, and again, with what you've seen big picture on the tightening, the Fed continuing to raise rates last year and pull money out of the balance sheet. The least likely scenario I think a lot of people would have forecasted was the stock market to be at an all-time high today as we're speaking, or near that. And again, the challenge, what's producing that is really a lot of momentum that you saw in 2021. Similar, you have crypto assets continuing to rally, tech, as you said, heavily in the semiconductor space, continuing to push the momentum in the market overall. And again, it's just a challenge when you talk about investing overall. I've said this for years. I mean, some of the most difficult investing environments are momentum markets because they're really not based on fundamentals in the short run. They're based on kind of investor sentiment and feeling good and overconfident about certain parts or certain areas of the market. And you're definitely seeing those trends unfold over the last year. So when you take a step back, David, outside of the momentum and just think big picture about the economy, the economy remains in solid footing, right? I mean, the projection now for first quarter GDP is right in that 2% range, which again, kind of is that Goldilocks scenario. It's not too good. It's not too low. It's kind of in that perfect medium at this point. And looking ahead, that's where we need to see the labor market, retail sales, and inflation to kind of confirm, where we're going ahead from here.
Yeah, so I mean, key data points for the month ahead, again, is really going to be that inflation print. There's going to be a large inflation number rolling off in the month of March. That's going to be reported, in the next several weeks. So that'll be kind of the last opportunity to break that 3% number in the short term. And then again, we'll have the Federal Reserve meeting. I think in this meeting, we'll also get the dot plot from the Federal Reserve that should give us updated guidance on where they see rates by the end of the year, because I think the expectations from the markets in terms of number of rate cuts has definitely come down. It'll be interesting to see if the Fed adjusts their thinking.
So David, as we turn to conversation, I mean, the $1 million question is always, where do you put your money now going forward, right? Where's the best value? Where's the safest return? I think as we think about that in a couple components, I think there's near term, which again is probably a little bit cautious given the rally in February, some of the Federal Reserve noise, this month, and then, kind of looking past that. And again, I think we've shared this graph in the past. I think it's interesting to bring it up to date a little bit. And what you're looking at here, the purple line are kind of the biggest, heaviest weights within the S&P 500, kind of the momentum, if you want to think about it that way. And again, this goes back over the last 2+ years. So that's clearly led the way in the markets. But then if you look at a couple different charts, the red one's interesting. So that's the equal weight within the S&P. So you take all 500 stocks, instead of weighting them by the size market cap of each company, you equally weight them. And again, it gives you kind of a sense as to is the breadth of the market participating. And you've seen really in the last couple of weeks, much more broad performance within the market. On the other hand, when you look at the equal weight going back the last 2 years, it's only fractionally positive. So the concern, today, is the market too high? In certain parts, arguably it is. On the other hand, there still is really, really good value within the breadth of the market and, other facets. And again, you bring that back to the overall economy. If we're growing in that 2% range, which is healthy long term, that impacts positively a lot of different industries within the market, not just tech, not just semiconductors. So again, as you think about the volatility overall, I think this is good to keep in context. And then the other thing you see here are dividend stocks, the yellow line. And to us, it's sort of a challenge. Overall, dividend stocks have been out of favor. We expect that to continue. And to us, the main reason is bonds are very competitive. With interest rates being where they are, you can upgrade quality of your fixed income portfolio. You can get more income. You can lock in more safety. So they're just in the markets feel like there's less of a demand overall for dividend stocks. So David, let's talk about, kind of putting this ahead. I always like the question, if you had $100 today, where you invest in that, given everything we're talking about with the Fed, market conditions, market performance, and kind of allocate your marginal $100 today.
Yeah, so I think, Jared, I think as Wayne from our team always says, right, it depends. There are some considerations because, again, the market shouldn't necessarily drive your investment decisions, in the long term, and your allocation is really driven by your financial plan and your goals, right? So this is where it's also on us to, temper some of the enthusiasm around some of the bubble-like valuations that we see, right? And then when you see a market downturn to continue to be strategic and disciplined as we invest. But if you're thinking about it from the perspective of a young professional, let's say somebody who's either recently out of school or in the middle of their career, they have 10 years plus to retirement, no immediate expenses, and let's say you're net saving a little bit every month, or saving at the end of the month, and then potentially there's like the annual bonus or some influx of cash that you might have. So again, kind of going back to your question, where do you put $100 for this person? I think the long-term allocation, the area that we've seen the strongest performance over 30 plus years of history with the firm has been actually 50 years, I guess, has been on the growth side of things. So long term, you still want to be allocated towards growth. Again, you wouldn't want to follow the bubble-like valuations and throw a lot of money into, let's say, tech, but you would still want to follow the momentum and have some exposure in that area. You wouldn't necessarily want to have high dividend exposure at the moment, and if you had any safety, it would be just a little bit in bonds, because again, long-term total return would be highest on a growth-like portfolio. So despite values being higher today, if you project it out over 5 or 10 years, just given historical returns, you would likely still end up further ahead if you were in a growth-like portfolio. And if you look at the numbers, on the previous graph, the S&P would kind of indicate that. If you're somebody who's approaching retirement, this is somebody who might be in or at or approaching retirement in the next 5 years. Again, similar in that there's no immediate expenses. And what this person may have noticed is over the course of the last 5 or 7 years, with a very strong market performance, a lot of growth on the equity side, they may have a higher allocation towards growth because of the portfolio returns, like I said, over the last, let's say, 5 years or 7 years. So that's where you could, allocate to be a little bit more conservative. But again, the question is where, and in that case, you would want to allocate a little bit more towards fixed income because again, you have more certainty. It allows you to take on more risk on the growth side of your portfolio, and you're reducing, the overall volatility. With rates where they are at about 6%, you're able to have more safety on the bond side of things. And then that allows you to take on more risk on growth versus, for example, having more exposure to high dividend paying stocks, which, as you saw in the previous graph, the could still fluctuate. So as you see the yellow line, it has the ability to drop. I think the bond market does as well, but you have more safety and certainty on the fixed income side of things.
Well, and David, I think investors today thinking about the markets, whether you're, early on your career, close to retirement, in retirement, I mean, bottom line, you want to keep your balance. Because again, on the one hand, the momentum markets long term, I mean, historically, it's where you can make the most still in this upsurge of momentum. On the other hand, when the momentum breaks, it's when you can lose a lot of money, like we saw in 2022. So a lot of this is making sure you're up to date, on things. And, a lot of these companies that have performed very, very well, especially in the big cap tech space recently, there's nothing wrong with taking 10, 20%, rebalancing and locking in some of those gains. And again, to me, that marginal $100, that blended growth type of approach makes a lot of sense. You still want your exposure to long-term growth, the balance, the breadth of the market valuation. On the other hand, the fixed income and bond market offers compelling value at this point for the stability and current income standpoint. So to us, that's kind of the way to think about things near term. And with that, we want to thank you for tuning in. We'll see what happens the rest of the month of March, and we'll touch base in a couple weeks.